Like, what was it like to be as a private student of his? Does this concept work? And is there an algorithm? There's a lot of people out there who say he's a fraud, he's a scammer. I came out on social media and I'm talking about algorithms. Bro, I was getting shot down. The algorithms don't work. Learning ICT concepts does not mean you're going to be a good trader.
So the first aha moment, I think I'm about 1.5 years into the journey. And I'm low-key I know what's going on, right? I know it's gonna go up or I know it's gonna go down. I'm kind of figuring out when I could get in. And probably like 2 months after that, I started actually just predicting trades. I wasn't making money, but I'd mark up a zone, mark up a break and retest, and it'd work out. I'm like, holy shit, I'm onto something, like it's working. And this is where I bought a one-on-one with this Asian dude that I had no idea who he was, that he was gonna analyze my trading, he's gonna fix everything, he's gonna tell me exactly what I was missing. I'm predicting the moves, but I'm not making money. You know what I mean? Like, it's like, let's say like you're shooting shots, you're making them, but it's not counting. I'm like, bro, what's going on? Like, it's not making. I'm like, you know what, bro? I'm ready. Like, let's get on this one-on-one. And this dude literally looked at everything that I sent him. He gave me a full, tight form, looked at everything, and he's like, all right, bro, I know what's wrong. And I'm ready for this like golden nugget he's about to drop. Yeah. He's like, you're just missing risk management.
The ICT trading techniques, and traders swear by it, claiming it's the holy grail of trading, while others call it just another overhyped scam. So, what's the truth? Does ICT really give traders an edge, or is it just another online gimmick? Today, we're breaking it all down.
Stick around, because by the end of this video, you'll know if ICT is legit or just another trading fantasy.
If you trade with that mindset and just simply look for how the market continuously supports itself, every time a down closed candle forms and it's likely to go up to a buy side liquidity pool, those down closed candles will act just like you are expecting your support resistance to offer support to the marketplace. And when it creates these little gaps, I call it a fair value gap, it comes down and goes into that, you can reasonably expect the algorithm to start repricing and spooling higher and reach to that liquidity pool over the course of a day or over the course of the session. And it takes a couple months just to spend time studying it, and you will quickly believe that there is absolutely an algorithm that's controlling price to the tick. And it's fascinating. It's a wonderful story. Even if you don't want to subscribe to the idea entirely, if you just go in and just approach price action study with these ideas in mind, you will see clearly that there's much more than trend lines and harmonic patterns and things in Nelly wave. All that stuff, I believe, and I leave it to the viewer to make the final determination on whether this is true for them or not. I believe they're distractions. And that's what I like about
ICT. The Inner Circle Trader ICT, created by Michael Huddleston, is a trading methodology that claims to teach traders how to think like smart money institutions, banks, and hedge funds. He claims that retail traders get trapped by market makers and that his strategy reveals how the real market moves. Sounds great, right? But here's where things get controversial.
Red flag, red flag, red flag.
Humiliating 6-month 97% loss and multiple failed Robbins Cup attempts. Only upload.
Like any popular trading method, ICT has its skeptics, and here's why.
All right, so my biggest tip when it comes to learning and mastering ICT concepts to become a profitable trader would be to master the basics. When you first get into ICT, there's so many different paths that you could go down. There's the 2022 mentorship, the 2016 core content, 23 and 24, and there's just so much information overload. And what I noticed with a lot of students is they want to learn everything all at once, and they never really focus and concentrate just on the basics. So they never become a master at them. So liquidity pools, order blocks, inefficiencies like volume imbalances and fair value gaps, and premium and discount. Those concepts alone should take you months at a time to learn each one of those. because there's so much nuance and there's so many complexities between all of them that it takes experience in the market to actually applying those tools and learning how they operate in the live market. So you might be somebody that studies order blocks for a week, and when it doesn't work for you, you go to another concept like liquidity rates. And when that doesn't work for you, right, you go to another concept like fair value gaps. And the key is to just continuously use one concept for a long period of time until it makes sense to you. Even though it's not working right now, doesn't mean it's not going to work in the future. You just have to get enough reps in with those specific concepts that you're a master at them. Of course, it's not going to make sense to you at first when you're applying it in live market conditions, and you're going to think that the concepts don't work, which tends to lead you down the path of, I need more knowledge, not more practice. But if you can accept the fact and recognize that you're just not good using the concepts, then at least you can practice continuously until you get good. So that's my best tip, is to focus on the basics and master them, and don't abandon them if you don't get results right away.
Now, to be fair, some traders do claim ICT works for them. They argue that once you master the concepts, you can spot high probability trades. Some traders have even passed prop firm challenges using ICT strategies. But here's the real question. Does ICT actually give a sustainable edge? Or is it just another way to rationalize market movements after they happen?
Let's talk about hindsight bias, the cognitive bias that we all kind of naturally have. And it's essentially, once you have information, once you've seen price play out, once you've seen something happen, you will naturally connect information in your head. You will naturally connect your pre-existing information to the current new information that you have. And like, you connect the dots, meaning it's very easy for you to then understand what happened. It's very easy for you to see price after it's played out and be like, I could have entered here, I could have exited here, this could have been my target, etc. You can then meticulously plan out a trade because you've seen the information. Yes, you can put it in replay mode, you can put it backwards, but once you've seen the information and you know where price has gone, you have the confidence, you have like, there's so many biases because you've already seen the information. Now, as humans, we naturally want to connect the dots, we naturally connect information in our head. And this is why oftentimes you may not even be noticing that after you've taken profit, for example, let's say price continues to absolutely obliterate in your direction and you would have made thousands more if you just held the position. It's so easy for you to then look at that and be like, oh, I should have held it because of X, Y, and Z, and it had a break and a retest and this and that, the other. But at the time, in actuality, it looked like it exceeded your target. It looked like it was depleting. It looked like it was a good time to take profit. Now, let me actually give you a live chart example. All right, so again, hindsight bias. It's a lot easier to understand price action and to see your setup take place after you have seen the bigger picture, after you've already seen where price ends up. It's a lot easier for you to then look for analysis in that direction. It's then easier for you to understand why certain movements played out, and you can see it kind of play by play because you can already see price action. For example, right here, let's say you're looking at German 30 and you're looking at New York session, you're like, yo, there was a crazy long continuation move. Price was super bullish and it didn't pull back, and I could have caught countless entries along the way, and etc, etc. It's very easy for you to then be like, okay, cool, there was a key level here and I should have seen it at the time, price retraced and it had a continuation. Whatever your analysis is, that is not the point. This is not a technical session, but it's a cognitive bias that makes you think that you have done something wrong. It makes you think that you missed a trading opportunity that you should have done or you could have done, etc. It's the should have and the could have. But in actuality, at the time when you had the information you had at that specific time, chances are it didn't look that good and you weren't thinking necessarily in that direction. Don't get it twisted. There are certain times where you may have just messed up, you may have just hesitated, you may have just missed a good trading opportunity. But oftentimes, if you actually go back and look at price action and look at some of the supposed trades that you think you may have missed out, if you really critically think and analyze and look back at the candle, the way that it looked when it was printing, it probably didn't look that good. We can't actually now put price in replay mode and try and visualize price the way that it would have been at the time, because again, we now are suffering from hindsight bias because we have already seen price action. And this is the point that I'm making, is that once you've seen the information, you cannot go back to not seeing the information. It's like, once you've seen it, you can't unsee it. So right now, even right here, based off of just pure price action, the information that we're seeing is bearish. Price is making lower lows and lower highs. Again, dependent on your strategy, just purely based off price action, there wouldn't be a reason to necessarily buy here, just on immediate thought. But because we've seen what price is doing, I'm sure a lot of you guys right here are actually looking at this piece of price action and you're thinking of numerous ways as to why you would have bought, and like you're trying to apply your analysis to a buy side because you've seen that price ends up going bullish. You see what I'm saying? So again, don't be so hard on yourself. Don't think that every single movement, just because there was a big move on the chart, it doesn't mean that you necessarily should have traded it, and it doesn't mean that you could have traded the movement.
What say you?